Welcome everyone. Just as a follow-up, we did a video about the 11-week cycle, how it helps to time events. Sometimes it's early, sometimes it's late, sometimes it's right on time, sometimes it doesn't even work. So we like to combine cycle analysis with market conditions. I've been warning about a situation in this market that has a lot of traders perplexed. The strength or the weakness of the breadth, the strength in a few names, and the overall weakness of other sectors, except for this week. We have several questions that our members have asked us in our live trading room, and a lot of new guys have come in. You know, people like hear about what others' successes are, and they like to try things, and then all of a sudden they join a room and nothing happens. And they get bored and they go elsewhere. I get that, and that's okay, because you're only as good as your trade yesterday, they say. But here's a model that we built in a class called Razor Focus, and you can see I am using that Razor Focus model platform here to share with you what is one of the models that we use. I created this as a workspace for a class that we gave to traders wanting to learn more about algo trading and to purchase the Person's Algo 17 Extreme program. It's a program that allows people to optimize, program, and develop their own strategies through TradeStation's technology. You can use these signals and trade them from Interactive Broker to Thinkorswim, or use them not just as trade signals to trade off of, but an indicator to know which side of the market to be on. One of my rules is, if a system is long in an active long position, why in the hell would you want to sell short? So this is one of the models that got flat the other day. So the first question is, when was the last trade we were in with the algo? Well, we actually were in a trade, took this profit. Blue lines are profit, as you can see, on a 60-minute basis. The algo got out Tuesday on a max bar holding period and has missed the last run-up, which was pretty spectacular over the last 3 trading sessions. Spectacular in the sense that it's on extremely light volume, number one. Spectacular in the sense that the breadth of the overall market has gone down, not up. In other words, only a few names are making the values increase, which is generally not all that healthy. It generally points to a correction. Another question we have that we want to answer and share with you and show you is what the VXX, the Volatility Index, is looking like. A lot of people have already recognized that the VXX has gone up while the S&P has gone up. And if you know much about that relationship, it generally takes the other form. Volatility goes down when the market goes up. So who's got this right? S&P buyers or VIX buyers? Because if the VIX buyers win out, that means the S&P 500 is getting ready for a sell-off. So that's one of the things that we need to look at. The performance I will share with you. Why do I rely on this model? You tell me. If you are in a system or a strategy or following a model, would you want a smooth equity curve like this, or would you want it chopped over, and would you want it not working? Well, quite frankly, this isn't a backtest study we just did. We created this file in January when we gave that class, and all of my students have this exact model. So where has the performance been? Since January 14, you can see this little, from this point here to that point there, we've seen an unbelievable rate of return in the market from this trading model. And that means it survived and made money in late January, early February, the March sell-off, and then the recovery since March. It's been long. It's just missed literally 18 trading hours of this week's trade in a really bizarre market environment. So now let's take a look at a key performance, and I'll just share this with you. A buy and hold model, it suggests if your system's any good, you should beat the buy and hold return. And as you can see, this has beat the buy and hold return. But also, what is the return on the account? It's actually 1,042.83%. It's only in the market a little more than half the time. So yes, it's missed trades. It's not been in the market all the time. So it has reliability. No system and no strategy and no trader can be in the market all the time unless you really are a buy and holder. Even an option trader can't be in the market all the time. Their options expire unless they roll over. And if you are a directional option trader and you're just simply buying long calls or long put options, you have time exposure that you're going to have to take those options off the table. So there is all types of different ways of trading a market. as a system trader and one that relies on indicators, there are going to be times where we get in the I think immortal words from Zelensky in the movie Tommy Boy. Hey, you slipped this one by me, savor the flavor, because it ain't going to happen again. Well, guess what? Sometimes market moves without us, and we're not there to participate. The key is not to chase things, do your homework, and be patient and wait for the next trade setup. All right. Right now, what do I see? This is a specialized volume indicator tool. It shows the momentum of the move. And since approximately August 11th, the market has zapped volume out. There's just been a very low volume environment in this market. In fact, last week's trade was the lowest volume week traded since Christmas week. So how can you rely on a market that's not really got full participation in the market? Could this have fueled this short covering rally, as I consider this, since options expire Friday and monthly options expired the prior week? Are there short funds that were betting that high momentum names like your Microsoft now, which is no longer a growth company, it's a momentum trade. When you look at Square, when you look at Chipotle Mexican Grill, Lululemon, when you look at these multiples, the earnings, when you look at their ratios, they're off the chart. Take Wayfair, for example, or even Zoom at 1,700 times projected next year's forward guidance. That's 1,700 times next year's earnings. Is there a chance of risking money there if you're buying and holding that? Sure there is, like with anything. All right, so let's answer a couple other questions. Let's jump into the Volatility ETN, the VXX, and let's share with you what our strategy signals look like there. All right. This is the Volatility, the VXX. Remember, this was an exchange-traded note, had a 10-year life history to it. It expired in 2019. They renamed it VXXB, and then they decided, let's go back to the original symbol VXX. So it's hard to get the data from the prior ETN. We do have that from our not just backtest studies, but our trade logs, because we've been trading this actively since approximately 2015. Now, here's the funny thing. When volatility goes down, it's generally associated by a stock market to go up. The VXX is a derivative of a derivative of a derivative of a derivative of a derivative, meaning the VXX is priced off of the first two front futures contracts of the VXX. So the VXX is priced off the VXX futures. The VXX futures is priced off the VIX index. The VIX index is derived by the bids and asks, or the valuation demand or lack thereof, for puts and calls in the S&P 500. The S&P 500 value is created by 503 stocks that are listed in the S&P 500. It's a derivative of a derivative of a derivative of a derivative of a derivative. That's what I'm trying to explain. It's very complex. Now, traditionally, when the stock market goes down, this thing soars to the upside. Right now, the stock market this week has rallied sharply. In fact, since even August 26th, the S&P 500 is up almost 1%. This is up almost 9%. It's unfathomable to think, why did volatility go up so much when the stock market rallied? So there's a disconnect, a divergence, and this is something that a lot of professional traders pay attention to. Who will win? The stock market going up or the VIX going up? The stock market going up should signal this to go down. This going up should signal the stock market to go down, and it didn't. So what's weird is that our strategy went flat on a max bar out on the S&P trading model and made money. This was short, as it should have been, and it should have continued to go down when the stock market made new highs. It didn't. What it did was it stopped itself out. Do we rely on this model? Yeah, the performance from left to right makes money, and it's a pretty decent model, to be honest with you. But as you can see, there are periods, and this only goes back since January of 2018, and you can see from left to right, it has a nice equity curve. Is it straight up? No. Does it miss trades? Yes. Does it take every single trade? No. But on average, it's something worth noting how we use this as a trade model and as trade signals to make money in the market. All right, let's look at one last item that I would wish to share with you. All right, I'm not sure. This is what we call my advanced decline page. We have brand new highs, and let's bring this into focus for you. We have brand new highs in the S&P 500. There it is. And the advanced decline cumulative ranking is lower. The McClellan oscillator is negative. So are we going to get a zero line reject and watch this McClellan line go down, or is it going to do a zero line cross and go positive, thus sending the stock market to even more newer new highs? Well, that I don't have the answer to. We need to watch this over time. So far this week, we have seen a situation where the advanced decline, while has neutralized, it is still in a negative mode. Why negative? Well, except for today, we have 306 of the S&P 500 stocks positive, 187 negative. So it's not gone positive yet to confirm this high is valid or can continue higher. Another interesting fact is while the Dow Jones Industrial Average took out a newer high, the advanced decline of the 30 stocks, it did not as well. So that's divergence number 2. This is divergence number 1. This is divergence number 2. And then let's look at the Russell. The Russell hasn't gone up, it hasn't gone down, it's actually gone sideways. But what has gone down is the advanced decline, divergence number 3. Is this whole rally on excessively strong volume? And that's another good question because our volume indicator suggests no. On balance volume says no. Our volume indicator says no. Volume indicator says no. On balance volume says yes. Cumulative volume's gone up. Cumulative volume. But this rally in the S&P is on light volume. The NASDAQ 100 has confirmed its breakout with a stronger AD line, and you can clearly see that's the advanced decline that broke out. But where's the volume on this? So as we approach near a very important risk, which is the person's quarterly pivot point resistance at 296.83. I mean, sometimes it shoots at it, a little bit above it. What we want to watch for is to see if we continuously get weakness from both a McClellan oscillator, and this is the McClellan oscillator formula modified, but it's taking the data instead of based off the NYSE. It's using the data off of the Qs. That's right. We actually modernized a lot of indicators to reflect what we trade. So we were almost in an oversold market. It's rallied back, and yet the advanced decline on the Qs, its McClellan oscillator momentum of moving average of breadth is not expressly positive. So again, the warning signs are still here. VIX, breadth, and volume. Can the market rotate and all the money come, at least some money off the table in Square, Zoom, Wayfair, Lululemon, and come into other sectors of the market like Bank America, transportation stocks? Can we see that great rotation to help support industrial materials and keep this as a more healthier market? That's the answer I don't have quite yet. Normally, in a market in August, it's one of the more difficult times to trade, but a 4-year election, that's a different story, especially this one right now. It's suspicious to me where the market rallied both on the combination of an option expiration and a Republican National Convention that as soon as it started, the market silently screamed higher as if it wanted to tell us 4 more years of the current environment. So I can tell you this, I am not a short seller in the market quite yet. Now let's show you one other item. While we have higher time frame weekly cycles, the 11-week cycle, which projected a high, which this is a high, what it does on this high, typically after a market goes up, it pauses or reverses. It's up to us to look at the conditions. We have just shared with you that the conditions of the market are questionable at best, especially with the advanced decline and this momentum loss. Now you're looking at one of our main trading rooms. We have 2. I don't think you can see the other one, but it's the algo room. This is the main room, stuff that we look at on a day-to-day basis. And some of my teachings have been based on this one chart that you see right here. If you are to look to sell, then let me point this up to you, and we'll go over here to the other computer model, and then what I'm going to do is bring this into focus. On almost each respective day, I have raised the, let's call it the yardage marker, if you will. if a market's going to go down, you notice that the blue line is a weekly pivot. This is a weekly pivot. This is a weekly pivot. So 3 weeks in a row, 4 actually, there's one here, was higher than the prior week. Weekly pivots have been going up. That's positive. And the daily fuchsia colored pivots, the daily pivots, have been above weekly. And what I've been saying is that in a very, one of my most basic teachings, will you say, if we'll say, that was taught in this book right here, which we just have the 2nd edition finished. This book came out 16 years ago. Almost everything you see in the trading strategies that I just shared with you in the Algo 17 are principles based on this book we wrote. So talk about standing the test of time. It's been pretty great. Here's the key. In an extremely bull market, the pivot will act as the low or strong support for the day. And I've been telling my clients, if you're looking to get bearish, we have signs, but the trigger will be on the first close that we can get below daily pivot and the last conditional change. So again, be on guard for a top. You could see my writing this morning. Be on top. We need to see a close, a 60-minute basis, AD lines. Look for the at least a 60-minute close below pivot. And those lines in the sand were written. They're right here. So if we are going to see a sell-off, there's 2 things that I want to see. I want to see volume divergence. We don't have. I want to see the market sell off on heavier volume. We don't have that either. And I also want to see, at the very least, if I'm looking other than a day trade to short scalp the market real quick, I want to see if there's going to be any concernable sell-off. At the very least, give me a 60-minute close below daily pivot. We haven't seen that. Another one would be, give me a daily close below the weekly pivot. So we open the door for that setup going into next week, the last week of August, and then again, we set that up for the first week of September. My guess is there's a little more pain for the bears ahead because a lot of people anticipate, and when everyone starts to turn positive in the market, that's when psychologically we're going to see things turn. The commitment of traders data is reflecting the fact that small speculators are still short this market. So therefore, we're not ready for the turn. And my fear is that by the time everyone gets tired of selling and tired of selling and tired of selling, then it's going to come down. The warnings are strong. They could always change. In other words, money could pour in and the advanced decline goes back up, and then we're going to see newer highs in the S&Ps. How much? Maybe 3% higher. We need to be on guard for that trigger rather than guess and wait. Short-term momentum traders are winning this game. Long-term investors are probably frustrated being in maybe high dividend yielding stocks, things like an Altria, or other financials that pay a dividend, growth stocks. They aren't working. Momentum names only is what's fueling the fire in this rally, and that typically doesn't end well. We need to be on guard for that. I wanted to give you an express observation and teaching lesson and a look-see into what we do and how we do it around here. Let me turn this back. I'm probably irritating everyone in the live trading room. Oh, by the way, you probably caught that one other indicator besides OBV, which is ATR. ATR is a function of measuring the volatility of a market or intraday or intra-period or period, end-of-period ranges. And the ATR, in this case, as this market's been going up, has been increasing, if you notice that. So that's generally not a positive sign of a smooth bullish market. There's changes that are potentially coming. It's up to us to guess on that. My job is not to prognosticate where the market's going to be 6 months from now, because even the best economist, Alan Greenspan, couldn't even figure it out. I call her Aunt B. She couldn't figure it out either. And then finally, I don't think that anyone in a COVID-19 pandemic world is capable of constructively figuring out the, again, consumer needs, consumer spending, and the recovery cycle of such an enormous shutdown from a global scale. So with that said, fingers on the market, keep a pulse on the market, and just remember, not every trader makes money all the time, but don't abandon any type of system that you have just because it falls out of favor. By the way, the worst time of most trading systems is in the month of August. And this is one of those systems, except for options traders in these names, such as Tesla, Microsoft, Apple, as we've been sharing in our live trading room here. And by the way, gang, This has been a heck of a year so far. We've had a good run, and I'm looking for more great successes in the coming weeks and months ahead. And I will keep you updated on the performance of the advanced decline work, as well as sector analysis and scan results of what we get. Until then, I hope you found this video enlightening and as well educational as to what are the tools that have worked in the past and will they continue to work in the future. Thanks for watching. By the way, this thing here is a bet, so don't judge me for having long hair. I have a bet. It's a $500 bet with a friend in Chicago, an old floor trader of mine, who would get and cave and get a haircut first before the end of August. The loser pays the winner's charity $500. So it's not going to me, and it's not going to Stewie. So I've also had people say, I'll pay you $500 just to cut the damn hair. You look silly. So I'm thinking of upping this and saying maybe we'll double or nothing to the end of the year. But that means I'm going to be harassed. And by the way, I got to wear it in a ponytail. We both have to be in ponytails. So it's not my look, but I know a lot of you guys have been making fun of me with the long hair, but that's the whole thing about what the long hair story is. Thanks for listening. Be good. Have a great weekend, man.